From Washington, this is the HPS Macrocast with Hamilton Place Strategies and Markets Policy Partners.
Good morning. It's Tony Fratto with Hamilton Place Strategies in New York City this week. My partners at Markets Policy Partners, Brendan Walsh, John Fagan, are in the DC headquarters for the HPS Macrocast. Guys, if people were listening to us last week, we told them the markets were not fully pricing in the effects of coronavirus.
All pricing in.
Right, and I don't know. I don't want to say that we sparked it. I'm not going to take credit for the rout that we saw this week, but it has been a historic rout. More than right now, looking at more than 3,500 points on the Dow, and putting aside points because points are kind of irrelevant anymore. But about a 12%. Drop across the board. It's not just the United States; it's global.
And one of the quickest kind of corrections we've seen of this size, too.
In fact, the quickest if a 10% is a correction, this is the quickest correction in market correction in history. And again, we're seeing it across all equity markets, in the bond markets. Amazing, but the 10-year is at an all-time record low, or touched an all-time record low. I don't know where it is at this moment, but 1.18.
Yeah, it's pretty much right at that record low. That is a really, really depressed level for 10-year Treasury yields.
Really, yeah. So the markets did react this week. They are pricing in what people think they know about coronavirus right now, and it is a much deeper, economic impact. The big questions, we haven't talked about how the market has reacted, and there's so much to talk about around this, but the financial economic effects, the market dynamics. One of the things we saw this week are, we had current and former Fed governors out talking about what the Fed ought to do. Former Minneapolis Fed President Narayama Kocherlakota was out early in the week pushing for an immediate 25 to 50 point rate cut. His view was that we shouldn't wait for the danger. We should take out this insurance policy. It's a cheap insurance policy to take. You want to do something to prevent any kind of and mitigate any kind of economic and financial fallout. Kevin Warsh yesterday in the op-ed in the Wall Street Journal on CNBC this morning talking about his view that there should be a coordinated rate cut among the global, largest financial centers, ECB, London, Japan, China, and the United States. With either a 25 or 50% cut. Again, the same kind of rationale that, that it may not do, it's not going to solve the problem. It's not going to solve a biological contagion problem, but you're going to do something to mitigate the economic effects of what we've seen so far. And and then James Bullard from the St. Louis Fed out today saying he would need to see it to get much, much worse before advocating for any kind of Fed policy response. Where are you guys seeing it?
Well, thanks, Tony. Yeah, the as we mentioned last week, the Treasury markets have been very downbeat and signaling some really dark economic outcomes, while the equity markets sort of blithely jogged northward and hit a all-time high last Wednesday. But underneath the hood, yes, we were definitely, as we referenced, seeing signs of caution, cracks, and narrowing leadership and that sort of thing. And now, obviously, the equity market is realigning with these risks that were reflected across treasuries, commodities, currencies as well. So the world, it's not a pleasant picture, but it certainly makes more sense. And when you reference talking about the Fed, I think it is really important to stress that the messaging that we've seen this week from and as you mentioned, St. Louis Fed President Bullard this morning coming out and really holding the line, saying that the rate cuts and the measures that they took over the past year put policy in a very good place to cushion the blow from this and so forth. And we heard Vice Chair Clarida obviously earlier this week flagging the risks to the economy from the coronavirus, but also saying that more clarity is needed, and that was echoed by a number of the other regional Fed presidents that spoke this week. The markets, however, beg to differ and are differing. Yeah, I was looking at the markets after Bullard's comments hit the tape, and really you didn't see much of a reaction in the Fed fund futures markets. There was a little bit of a dither, but right now, the Fed fund futures markets are pricing in over 100% chance of a cut at the March meeting, which is March 18th, and non-zero and rising or meaningful odds that they actually go 50 basis points. The futures are pricing in almost two full hikes,
cuts,
almost two full cuts by April, and certainly two full cuts by June. This is is forecasting a very aggressive Fed response, and that is, we can't think of any shock to this, any kind of shock over the last decade that hasn't featured a meaningful central bank response and a proactive central bank response. For the Fed to stay on the sidelines for this one would be that would definitely be out of off brand for their and jarring for the expectations of the markets, I'd say.
Though the one thing I will say about the predictability of the markets, the equity kind of is the fun one, and it goes high, and then it is the late to the party, where the bond market is supposed to be the smart guys. And we've been saying that for a while, that the bond market has been pricing in all year a much more downbeat global economic view. Today, the equity market is pricing in like a global recession, freaking out. But when you look at the 2-year is at 92 basis points. It's rallied, a decent amount, 15, 20 basis points. But if the bond market was pricing in a global recession, the 2-year would be very close to zero. So there's actually a little bit of optimism priced into the bond market comparative to what the narrative is being spoken through the equity market right now.
Yeah, that classic, and we referenced it yesterday, that classic 2-year, 10-year yield spread, the so-called Treasury yield curve. It didn't invert. It looked like it was ready to invert and give us that traditional and very disquieting recession signal that we've talked about in the past, but it's disinverted, and the reason it's steepened quite considerably over the last few sessions, largely predicated on the market pricing in a lot more Fed rate cut activity. And if the Fed persists in trying to argue that they need more information, they've got to wait for the next few meetings, if all else being equal, you might see that more optimistic tone from the bond market reverse relatively quickly.
Right. And Tony, I think that's an important point when we were talking about if the Fed cuts, what's the economic effects? And I want to have that discussion. But in the last 10 years, the markets are as big of a part of the Fed's decision making and also the economy, too. So you can't just ignore the market. There's been a Fed put for 10 years, and the market's become aware of it. So if the Fed's just going to stay on the sidelines today and let the market go down 20% when they could have maybe kept it at 10 to 15%, that then seeps into consumer behavior and fear and things like that.
So you hate to anthropomorphize the market, the Mr. Market motif, that sort of thing. But, the markets, there's a reason they called it the taper tantrum back in 2013. The markets threw a fit and tried to convince the Fed not to do what they didn't want them to do. And that is you can use that same kind of framework if the Fed persists in staying on the sidelines. The market is more likely to throw a quote unquote tantrum to try to get what it is looking for.
Yeah, and look, it's not that that there isn't an economic impact, right?
Right.
Right. I mean, this is what we were talking about last week, that there were, real and hidden economic impacts that didn't seem to be reflected in the near term outlook for investors. They just seem to be, for whatever reason, in equity markets, ignoring that there was going to be some, a near term hit, and some of the costs that were going to be permanent costs, especially on the service side. And I was thinking about it even further on things like as I was watching some report about some retailers waiting for their spring fashions to come in, right? Or summer.
Yeah,
fashions,
they might not
whatever,
be there.
Whatever it was.
The ship is
Like
quarantined.
the next seasonal. Yeah, like there are certain industries where like it's just a lot. If you don't buy, your spring golf shirts or whatever, it gets to a point where you
your
don't,
Easter
you
dress.
don't buy them anymore. The shelf space isn't there for them because now they're going to be like back to school stocking starts in June.
Mm-hmm.
It's like you just kind of get out of whack because there are a lot of seasonal things, and it's not just it's clothes, it's lawn mowers, and a whole lot of industries. A lot of industries are very seasonal. Tourism is seasonal, and when you miss the window, it goes. So we know that. So the economic impact is real. Financial impact is really interesting. And I think not, less well known. There are, a lot of questions about sort of market structure and, who are the participants in the market that might have an impact. There's a question, we've seen a lot of coverage about, the biological contagion of the disease, of the virus. What are financial contagion methods? Like how does this impact firms that where it's not just a passing thing, that there's a lasting impact on the financial side?
Right. So back when I was at the Treasury Markets Room, and I was there
Actually, John, that's exactly what I really wanted to ask. Is like when you were back in the room and you were going to have to go talk to senior officials and reading the market and saying, look, here's what we think is going to happen, and this is how you're going to tell senior Treasury officials, this is how we think the markets are treating this and reacting to it, and could get worse. What would your story be? How would you talk about that?
So the framework that we would go up to senior officials to speak about when we had episodes of market volatility like this was roughly, to sort of thumbnail sketch it, it's 2001 versus 2008. Is this a nasty cyclical downturn like 2001, or is this a systemic problem like 2008? Does this, is this a flesh wound or a much more systemic problem that shakes the foundations? When you look at things like basically the orderly functioning of markets was very key. Is trading being accomplished in a smooth and orderly fashion? Yes, downbeat. Yes, stressed. But are orders being filled? Are trading desks? Is there liquidity in the markets? Are you seeing gappy price action? Are you seeing flash crashy kind of dynamics in certain asset classes? Are you getting a sense that that key distinction between market order and disorder? And it is a bit of an art, not a science, and
CDS spreads blowing out,
right? And then looking, and so the orderliness of markets was one big indicator of that this was not a systemic. The other was looking at credit. Basically, if you're looking at credit markets and about the credit worthiness of companies, you can certainly have equity valuations derate, and that doesn't necessarily implicate on a grand scale the overall assessment of the credit worthiness of those companies.
Sometimes it's a healthy thing.
Right.
Valuations were stretched already.
Right.
We were due for a correction, irrelevant of the coronavirus.
Yeah, right. Brent, well, that's what I was. So I have a question here that I did want to raise here, which is this. Markets were pretty rich, right?
And by all indicators, whether it be exposure, and also last week hedge funds massively ramped up. They had been on the sidelines for the 2020 rally, and they kind of threw in the towel and bought. So exposure by institutional investors was at historical highs. Bullishness amongst both retail and institutional investors was all-time high. When you get there, you're due for a correction. It's usually 5 to 10%. I think the coronavirus was the thing that sparked this, and now people are focusing on this. So now this is essentially could be a black swan event where it could completely derail the global economy, and now people are pricing in that. But I think we were due, to have a 5 to 10% correction. Now what we have to do is all essentially become epidemiologists and decide whether this is going to massively derail what we think that the globe is going to grow and countries are going to earn, or whether this is a short-time thing. So in 2014, we freaked out very similar about Ebola. And that was a kind of a 2-week kind of correction. Is that what we're going through here, or is this a bigger issue? I don't have the answer.
And obviously we're much, so it's already much longer and much deeper than Ebola was. So I mean, we obviously learned some things from it. As it goes on longer, and as the market correction goes deeper, though, you do what's the Warren Buffett thing. When the tide goes out, you find out who's whatever you find out who's swimming naked and who was swimming naked. So if you were the kinds of concerns you could see are anyone who's highly leveraged. Yeah.
So in the United States, and we've talked about that, that's the shale patch guys. They live in the leveraged loan market, and they make up a huge percentage of it. So at $52, they're okay. But when the oil price starts getting down in the 40s, those guys have a hard time paying their bills.
Yeah, and obviously looking at the credit spreads, you can look at we're monitoring it right now, the credit spreads on high yield debt, and that's obviously the more sensitive portion of the credit markets. Those are not going in the right direction. The spreads on high yield debt and particularly energy credits, we can look at that sector level, but our sort of comparator, more recent comparator, was the late 2015, early 2016 deflation scare.
Yeah.
And right now, at least, we are well shy of the levels of credit stress that were reflected during that time period.
About half, right?
Yeah. Mm-hmm. We're getting
a little closer.
We're getting a little closer, but it's still a far cry from those stress levels seen there. And so that is. These credit markets and credit spreads are a place where you can look at more systemic kinds of pressures.
And also, I think it's important to note in that 16 period, for about 6 months, we kind of climbed there, and then we kind of freaked out and blew out. But once the Fed started to address that, we went immediately in a good way. The rates, the spreads went way down immediately.
Right. That was that coordinated global easing that came out of the Shanghai G20 meeting, which market participants shorthanded as the Shanghai Consensus. Every meaningful central bank basically hit the gas altogether, with the Chinese dumping an enormous amount of fiscal stimulus into the system as well. And you got a pretty swift recovery in financial markets, which was reflected in, 12 months later, you got 2017 with a very pleasant global synchronized expansion.
Yeah.
And so we've seen what Kevin Wars, you mentioned his op-ed in the Wall Street Journal yesterday. It's getting an enormous amount of attention on Wall Street, and it's calling for a replay of that very same strategy.
So the argument that the basic argument is that that you have an opportunity to do something. So even if it's not the perfect tool, you do it. What harm can it do?
Right. And
that then if we find out a month from now, we should say, by the way, that the next the next FOMC meeting is March 18th. So that would be the next regular scheduled opportunity for the FOMC to do something. Both Coach Lakota and Warsh are calling for an over the weekend, conference call among the major central banks to do something to announce before markets open on Monday, which brings back, that does in fact bring back a lot of really, awful financial crisis memories for me. But that's that's what he's pushing for, that kind of like sort of big statement that will tell the world we're doing the things that we can, and we're on top of this, and we're all working together to make sure things don't get bad. My question to you guys is, like, just functionally, what exactly would a quarter or 50-point rate cut do? What would it do, there are a lot of economic effects of the virus that we know are not going to be impacted by whether money is cheaper or not. But what do you think the market sentiment would be?
Well, I think right now, as we discussed, basically a 50 basis point rate cut at this point, which is being reflected into Treasury markets, is we've gotten to a position where it may not be the answer to the economy's problems. It's not going to cure the coronavirus, that sort of thing. However, it is part of a strategy for calming markets down. Yeah. You want to make sure that markets are, trying to deal with this rationally, that they don't get into that self-perpetuating downward spiral where selling just begets more selling. The Fed is supposed to, and has in the past, come out and sort of cut these negative feedback loops with things like rate cuts. And I think at this point, because those 50 basis point rate cuts are priced in, if you don't do them, then the markets are going to have an adverse
and
reaction.
Then also on the flip side, the fear of, if you cut, you're signaling that you're worried. I would agree with that if the market hadn't already priced it in. The fact that it's already priced in, I think the bigger risk is not doing it. It doesn't necessarily be 50, but you should probably do 25.
Right, yeah. If you would like to see the 2-year 10-year Treasury yield curve invert, by all means, don't cut in March.
Yeah, but also to your point,
invert it right away.
But also to your point, Tony, I agree that it's not going to have a stimulative effect on the economy while we're kind of in shutdown mode, quarantine mode, while the coronavirus. 50 basis points is not going to send the Japanese kids back to school. They're out until March. We might have to shut down schools, but what it can do is hopefully in 3 months, when we get this thing under control and you have all these businesses that lost out on a huge amount of revenue, you can have a much more a looser monetary policy and an easier access to credit to get you through the rest of the year and get back to business in 2021.
The Fed's in a tough place, though, isn't it, from a timing standpoint? They've got we said, you talk about it might take 3 months to get this done. Their next meeting is in 3 weeks.
3 weeks, yeah.
I mean, 3 weeks right now. If we think of where we were, 10 days ago, we had market highs, and people thinking, markets somehow thinking of a sort of relatively benign situation.
Yeah, and pretty good economic data.
Yeah, today markets are in something like free fall.
Yes, agreed.
Right. We reached I think the low of the day was another another like 3.5% drop in the Dow and S&P 500. So another big downdraft.
Yeah.
Today. 3 weeks from today.
It's a really important point.
It's an eternity.
Because as we said, you're not cutting for the economy. You're cutting for the markets on this point. So basically, you need to do one of two things if you think that a Fed cut can save you. You either need to have an intermeeting meeting and do it on Monday or whatever, or Fed Powell just has to do it on his own and give a speech and say, I'm in favor. I think both will have the same effect.
I agree. All right, guys, let's why don't we take a break here and we'll come back with more on this and a few other subjects. You're listening to the HPS Macrocast.
HPS is seeking a senior-level public affairs professional to join our dynamic team. If you have 10 years or more of relevant experience in communications and you're interested in the topics discussed on the HPS Macrocast, this just might be the role for you. Apply today at hamiltonplacestrategies.com/careers.
All right, we're back with HPS Macrocast. Guys, I feel like we could talk about coronavirus and the markets for a long time, but I think we'll be back.
Unfortunately, I think we will be, right?
Yeah. There's more politics again. We saw what happened in Nevada last week, big week for Bernie. There was, a lot of talk that that Bernie Sanders coming close to cementing his position as the front runner.
Yep.
Coming close to the presumption that he is very much the likely nominee. I don't think we're there yet, with South Carolina coming tomorrow and Super Tuesday coming on Tuesday. But, this view that I hear it here and there that people are the likelihood that he is going to be the nominee and could win is what's really spooking markets. I think the president mentioned that as well. You hear at the same time though that everyone up here in New York thinks Trump is a lock to win. So which is it? They spooked about Bernie, potentially Bernie winning, or they or do they all believe that that Trump's going to win? At any rate, I don't think that's where the market.
Maybe on Monday and Tuesday, but
Bernie Sanders at all.
No, I think that's we've seen a lot of prognostications that may be somewhat biased or self-serving on the on market folks prognosticating on the political winds buffeting risk assets. You can make the argument that perhaps there's a sense that the coronavirus, if it turns into a pandemic, creates a lot of unknowns for the election and might dampen President Trump's reelection chances and construct this sort of thing. It's really hard when you look at financial markets to make any sort of definitive case about this. The reaction function that we've seen has been so clearly, on the headlines relating to coronavirus, and to the, it just hasn't corresponded well with with Bernie Sanders' polling numbers. We just don't see it. Yeah. We've been very skeptical.
Yeah.
I mean, individual stocks you can maybe make that case.
No, totally. But on Monday and Tuesday, or even last week, that was the discussion kind of going around on Wall Street. But in the last couple of days, it's flipped to the opposite. Is the coronavirus going to send us in a recession and be the thing that derails Trump's reelection bid?
Yeah, the risk there for the administration is twofold, right? And let me just say, I don't think that's the case, right? I mean,
yeah. This is just the narrative that's beginning.
Yeah, you have a week like today, and I still think, fortunately for the United States, we're in a, the economy is fundamentally really strong. I mean, there is a lot of strength there, and if you're going to have to deal with some kind of shock, we were hardly ever in a better position to deal with a shock, and so that's if that's what this is, then we're in a good position for it. And I don't think it tips us into recession. I don't even think it tips China into recession, although they could very well have a negative quarter here. So I'm not worried about that so much. But we could see things go south. If growth is in the one digits, as a one handle instead of a two handle and closer to zero. That's not recession, but that doesn't look great either for the administration. The biggest risk for them though is on competency, and so if the disease spreads and gets worse here in the United States, then you have a situation where people question the competency of the administration, and I don't want to go back into sort of relitigating what I dealt with in the Bush administration with Katrina, that there were a lot of things, things went wrong, and it wasn't a question of it was a question of what the charges, which I think were completely unfounded, but charges that the administration was indifferent to what was going on. But you have the risk of that happening if things get bad. So I think that's the greatest risk for them, and they really ought to be spending more time focusing on the problem rather than going out and telling people to buy stocks as they did on Monday, which would have been a disaster if anyone took their advice this week.
That's a great point.
All right, guys, we actually did have some data this week and today. We have more coming next week, including the mother of all jobs reports coming up next Friday. Why don't we take a break right now, and we'll come back and talk data and the outlook next week. You're listening to the HPS Macrocast.
On the first Friday of every month, HBS analyzes the latest jobs and labor market data in a digestible format. Sign up for our reports at hamiltonplacestrategies.com or on Twitter at HPS Insight.
All right, we're back. So we're going to see, when we get together next Friday, we're going to see what happens with the outcome in South Carolina and Super Tuesday. So we'll
any predictions on your part?
I think Biden is going to win, actually going away in South Carolina. I think there's a very good chance we're going to see Elizabeth Warren in 4th or 5th place again, which really should spell the end of her campaign. Klobuchar should be looking for the exits. Also, you need to narrow the contestants here going into Super Tuesday. I don't think they're actually going to get out ahead of Super Tuesday. I think they're all going to stay in through Super Tuesday and see how that plays out. But and then Super Tuesday is going to be a free for all. I still think because Bernie has he has a huge lead in California. He is going to come away from Super Tuesday with a fairly strong lead in the delegate count. But if Super Tuesday does the thing that it needs to do, which is like weed out a lot of the really underfunded and undersupported players, it's the big test for Mike Bloomberg. He gets that's his Super Bowl, is Super Tuesday. He needs to perform really well, or the whole or his whole strategy falls apart. And so we'll know that, so we'll factor that into our thinking too. And then no one knows how it's a lot of states. It's 14 states, and people are competing on some cases in their home turf and in places that they haven't even spent a dime of media in. So it's going to be a very strange day, but I think we'll have a lot more clarity this time next week when we're talking. And we'll also have the jobs report next Friday. We had some other data this week. I thought PCE was out this morning, which was pretty strong.
Yeah, so that was probably the biggest news of the week. Again, because of Corona, people start dismissing the upcoming data. But personal income was up 0.6% month over month, and about half of it was due to actually getting higher income from your employers, and then the other half was Social Security benefits, and also the Affordable Care Act tax refund hit a lot of people's paychecks this month. But then also the spending was up 0.2%, a little below consensus, but still strong. But more importantly, it was heavily driven by purchases of motor vehicles, which last year or two has been a little weaker than we expected. That's partially because the cars are getting so good now. People are holding off to get the next model because there's so much increases in it. But it is a big part of our economy, so you want people buying cars. But then, more importantly, within that same report, we get the PCE price index, and that's the Fed's preferred gauge, where they focus on the core PCE, and that was only up 0.1% on a monthly basis. But they focus on the year-to-year gains, and core is up now 1.6%, which is a little above 1.5% in December. So January is up 1.6%, but they still have that 2% annual target. So they have plenty of cover on the inflation front if they do want to cut 25 or 50 basis points to combat the coronavirus.
And then we're going to get jobs. I mean, which is not going to be, I don't think there's any coronavirus impact in.
No, there really shouldn't
jobs,
be.
Right?
Yeah. So this is the February employment report. I mean, we had that blowout 225 in January. So, I mean, there could be a little bit. So this is a hard one to judge if you're trying to predict what's going to happen. The market's kind of just looking for the 178 gain, which is kind of like the average of what we do. But that will definitely be the big data point. I mean, it's always the big data point, but also to see if Corona, it did seep into the U.S. employment market.
The places you would look for that are I guess, transportation, shipping.
Yep. Restaurants too.
Tourism.
Yeah, it would be disturbing if it already seeped into the service sector. I wouldn't expect that, but that would be a little bit of a. That's what the Fed's going to be focused on for this report. But then also when we're talking about global centralized easing, the RBA, the Reserve Bank of Australia, and the Bank of Canada also have meetings next week. So if you were going to do it, if you were going to do something coordinated, next week might be the one to do it.
Do we have any? I mean, we know that airlines, have cut back on flights, quite a bit. And but I mean, do we have any indication that, in fact, if you're, I talked about this last week about people not going to Disney, right? Is that really happening? People not going to Disney? Are people not going to crowds? Are they not buying, sports tickets? Not gathering in crowds and concerts and things like that. I mean, I haven't seen any even anecdotal evidence that's happened, with the exception of the Chinese and Asian tourism business to the United States and Europe. I mean, that's the only thing I've really seen. And again, I haven't even seen real data on it, except for sort of canceled flights kinds of things. But I haven't really seen like any really good anecdotal data or stories on that yet. No. And in the United States, I don't think that's happened yet.
Though you are starting to get the discussions about, the upcoming MLB season and things like that, how they're going to deal with it. But nothing significant. But I don't know if it's ironic, but it's just really bad luck. Corona beer has had their lowest sales ever. But it also goes into, we were talking about the service sector. The consumer's hard to predict. So, and once you lose those sales, they're never coming back. So if this seeps into the psyche, if people aren't buying Corona beer or going to Chinese restaurants, that doesn't come back. And then you could really just lock yourself in a house for a couple months and kind of derail us.
I'm going to do my part to turn back this unjustified bias against Corona beer and drink my share and then some.
I think I'm going to take you up on that too. I'm going to go on.
I might need a few Coronas.
In fact, I'm going to tweet about the fact that I'm going out to buy Corona beer, and I think everyone else ought to as well. And they're not a sponsor of this show, but we would certainly welcome them.
Well, I think that's the most important thing that we can do.
Exactly. Guys, thanks again. Have a great weekend. Everyone out there, be safe, practice good hygiene.
Fist bumps.
And we'll talk to you next week on the Macrocast.
Thank you for listening to the HPS Macrocast. Please remember to subscribe, rate, and share. Find more from Hamilton Place Strategies at hamiltonplacestrategies.com and follow Tony Fratto on Twitter @TonyFratto. Learn more about John Fagan, Brendan Walsh, and the work they do at Markets Policy Partners by visiting marketspolicy.com.